Okay, let's dive right into today's analysis. We're looking at a pretty major shift in the market right now. The institutional engine, well, it's hesitating. And honestly, that leads us to the absolute biggest question on everyone's mind today. What actually happens when the most powerful investors in the world just start to hesitate? So let's set the scene here. As of May 2026, Bitcoin's recent surge up to $82,000 has officially hit a wall. Now, your long-term holders, they're standing firm. But we're seeing this really fascinating shift in the smart money. It's got the whole market looking around and asking, is this rally completely over, or are we literally just catching our breath? To really understand this hesitation, you've got to look at the recent price action. Bitcoin touched that local peak of over 82 grand, but then the momentum just kind of faded. It dragged the price right back down toward that mid-$77,000 range. But to figure out the why behind all this, we need to look a little deeper than just the price tag. We hear Bitcoin called digital capital all the time, right? Basically, think of it as economic wealth stored in a digital format that can move instantly, anywhere across the globe. Why does that matter to us? Because for the first time in history, we have a global 24/7 asset that doesn't have to ask a bank for permission to move value. It's totally unprecedented. But even with that revolutionary foundation, the overall market structure is currently softening. And if you're wondering what that means, market structure is really just a fancy way of describing the health and honestly the vibe of the current trading environment. Right now, it's a complete tale of two mindsets. On one hand, short-term demand and speculative energy are cooling off fast. But on the flip side, long-term conviction remains totally anchored at an all-time high. It's wild to see them split like this. So where exactly is all this friction coming from? Well, you know the main bridge between traditional finance and crypto is the ETF, the exchange-traded fund. And these are massive because they finally let giant institutions, we're talking pension funds, insurance companies, buy Bitcoin safely right through their standard everyday brokerage accounts. But here's the catch. Today, that institutional conviction is looking surprisingly shaky. ETF net flows have actually deteriorated sharply. And sure, trade volume is technically up 7%, but the data tells us this is way more about cautious participation than aggressive, confident buying. Yet, even with all this institutional cooling off, there's this fascinating countermetric. Bitcoin's realized cap has just hit a staggering, record-breaking $872 billion. Now, realized cap is just the total value of all coins calculated at the exact price they were last moved. So, what does a record high actually tell us? It means that despite the recent dip in price, more capital is essentially locked into the network than ever before. People aren't panic selling, they are holding. And while the market holds its breath on prices, there's a massive shift happening behind the scenes. The regulatory fog is finally lifting. The SEC just released its final interpretation on how federal securities laws apply to digital assets. They've officially created crystal clear categories, like digital commodities for things like Bitcoin and Ether versus digital securities. Now, why do these regulations matter so much? Because they give us the rules of the road. Without them, traditional mega companies are literally just too afraid of getting sued to even join the market. This new clarity is specifically designed to slash legal costs and finally encourage real on-chain financial innovation right here in the US. But look, crypto obviously doesn't exist in a vacuum. Everything in this space is heavily tied to macroeconomics, the big picture global economy. Specifically, all eyes are on the Fed. Because of ongoing conflicts in the Middle East and soaring energy prices, the Federal Reserve is expected to keep interest rates stubbornly steady at 3.5 to 3.75% for the rest of 2026. You might be wondering, why do interest rates dictate crypto prices so much? Well, it's a simple balancing act. When rates are high, risky assets like crypto have to compete directly with safe government bonds. I mean, if you can get a guaranteed decent return just by leaving your cash in the bank, you're way less likely to gamble on a volatile digital coin, right? All right, finally, let's talk about the grease keeping all these gears turning, stablecoins and liquidity. In case you aren't super familiar, stablecoins are digital assets designed to stay at a completely steady value of exactly $1. And under recent legislation known as the Genius Act, payment stablecoins issued by permitted banks have officially been declared not securities. This is a massive, massive win for market liquidity. And liquidity is simply how easily you can buy or sell an asset without the price jumping wildly all over the place. Because here's the thing, high liquidity from stablecoins basically paves the way for a truly friction-free economy. We are talking about a world where property and credit can be managed and traded 24/7. No more waiting around for a bank to open its doors on a Monday morning just to get your business done. It's a real game changer. So let's pull this all together. The market is consolidating, regulators are finally signing off, and the tech is accelerating faster than ever before. The daily noise might be super loud right now, but the overarching signal is crystal clear. The entire global financial system is being re-architected in real time. So the only question left is, as the smart money hesitates, are they preparing to retreat, or are they just loading up for the next massive leap forward?